Today we're talking about getting started on the stock market. Stay tuned. Hello there and welcome to another video on investing in the stock market. Really cool video today. Now I know most of my regular viewers are already invested in the stock market, but I still get a lot of questions about how to get started, how to get set up with the broker, and what stocks you should begin with. So here are the fundamental steps I think you should take when considering getting started on the stock market. So I've touched on almost all of them before, but I thought I would just gather them up in one list. So the first thing you do, obviously, if you want to invest, is save up some money. Preferably as much money as possible, and it should be money that you can set aside for at least 5 years. I would say minimum 3 years and ideally 10 to 15 years. You know, the stock market is a great place to have your money. It's very safe, and over a long time it usually goes up and up and up, and it goes up just about 8% every year, but there is a lot of volatility. It goes up and down, and you never know what's going to happen. There could be a crash, there could be a correction. You never know, so make sure you can have your money in the market for a long period of time to make sure you get that average return. And don't count on the money you have in the stock market. This should be money you don't need. It shouldn't be money you need to support yourself. It should just be leftovers. And if you have the patience to, I think you should learn the basics and common mistakes of investing. Now I myself read up on the stock market, and I watched a lot of documentaries, but I pretty much made all the fundamental mistakes you could possibly make within my first year. And I wish I'd taken some time and really understood the pitfalls of investing. So take some time, watch my videos or some other videos, look up the common mistakes and make sure that you get off to a good start. Now, some of the common mistakes are putting all your money in one or two stocks, paying too much in fees and management fees to mutual funds, broker fees, setup fees, etc. And you should also buy and hold, which means you should hold your stocks for a long period of time. Just go long in stocks. If you do a lot of trading, you'll get a lot of costs, and you're basically trying to time the market. If you're selling and buying stocks all the time, getting in and out and trying to make quick profits, you usually end up chasing the profits, which usually doesn't work out. It's a losing game, and timing the market is very, very difficult. So just buy a stock and hold it for the long run. If you want to pick your own stocks, look at the fundamentals of business and not the PE ratio. So make sure you learn the business before you consider investing in the stock. And dividend is more important than people think. It can give you more money than the actual stock price going up. So make sure you read up on dividend and the importance of it. Find a trusted and reasonable broker. The most important thing is that you trust the broker. And then comes the fees, because with a broker you have to pay a fee every time you buy or sell a stock. It's called a transactional fee. And so with some brokers you have to pay an annual fee and maybe even a setup fee. So make sure you understand all the fees you're paying and pay attention to how much money is lost in the transactions. I made a big mistake on this one. And make sure, take your time to pick a broker. Lotta. Next up, when you start investing, I would say go with index funds, ETFs, or blue chip stocks. So index funds are big baskets of stocks, maybe hundreds of companies, which tracks an index. So it could be a United States index, European index, financial index, technology index, etc. ETFs are index funds, just they're traded like normal stocks, so you can buy and sell them anytime on the stock market. And they're usually a bit more reasonable than index funds. Blue chip stocks are basically the biggest companies in the world, the top 500,000 companies. When it comes to index funds, now these are just the ones I can personally recommend. I don't necessarily own all of these, so you have to do your own research, but these are some good ones to start out with. So for index funds, there's going to be a lot of Vanguard, and the reason why I recommend Vanguard is it's the cheapest, most efficient way to invest in my opinion, and it's great for beginners. So Vanguard Life Strategy funds are all-in-one index fund, mutual funds, where you can choose between different levels of risk, and it will contain growth stocks, income stocks, and bonds, and the ratio depends on what you like. So you can just pick a risk rate from 1 to 5, and you'll get a balanced fund based on that. It's genius. And the select index Vanguard funds are the broad index funds, which are great for getting started. And these are funds where you can put all your money in one index fund and you're basically 100% diversified. So an example would be the Vanguard Global Stock Market Index Fund, where you get stocks from all around the world, 50-50 US, international. It's just a one-stop for all investments. So some of the tickers are VASGX, VASIX. A ticker symbol is a bunch of letters which represents a stock. So you can just search this up on your broker or on the stock exchange, and you can click buy and sell. When it comes to ETFs, which are generally better versions of index funds, they are very cheap. From Vanguard, you have the S&P 500 ETF, the dividend ETF, total world global stock market. Then you have the SPDR S&P 500 fund, the Vanguard Europe fund, Vanguard Asia Pacific fund, Nasdaq index fund, Dow Jones Industrial Average, and then you have the Schwab US balanced index fund or something like that. So these are all well diversified, very safe, cheap, efficient index funds, which also usually pays at least 1.5% dividend. When it comes to blue chips, these are the traditional actual companies where you buy stock of one company. To me, it's the most interesting way of investing. It's the way investing is supposed to be. It's more risky, but you can also get more gains. And the safest way is to just go with the biggest, most well-known companies. So some of my personal, I can't recommend them 100%, but these are all safe, good companies. So you have Apple, Microsoft, JP Morgan, Lockheed Martin, Boeing, Amazon, Coca-Cola Company, Intel Corporation, Lockheed Martin for a second time actually, BMW, SAP SE, Nestle, and Novo Nordisk. These are just some of the companies. I've written a couple of them twice, I see. So these are safe bets. These are companies which are not going anywhere, and they all usually pay a really good dividend. Now lastly, and the one that's going to probably cost you the most money and the most dangerous thing for investors, is to let your emotions control your investing. If you invest based on emotions, you'll usually end up chasing profits, and you'll basically sell low and buy high. Because when a stock is doing great, everything is a party, you think, wow, I want to be a part of this, let's buy. But when it all comes crashing down and everyone's shouting, you know, run for your lives, jump ship, you're gonna sell. So you're gonna do the opposite of what you should do. So you need to be like a robot. You need to leave your emotions out of it and just focus on the numbers and fundamentals. There is no emotions in the stock market. There shouldn't be. Numbers don't have any feelings, so don't be sentimental. And if you can't control your emotions, I would suggest putting all your money in an index fund or ETFs, because the job is done for you. But if you have some ice in your stomach and you think you've got a good head on your shoulders, try and pick your own stocks and see how it goes. I would say put maybe 50, 60, 70% of your money in an index fund or ETFs, then pick some companies for the remaining 30, 40%. See how it goes. If you beat the market year after year after year, like I've done, you should just go with picking stocks. You definitely have an ability to sort of at least pick out a couple of companies which are going to outperform the market, as we say, so just go for it. Don't let people tell you what to do. Don't listen to doomsayers which are panicking every time the stock market sells off. Don't believe the euphoria when the stock market just keeps going up and up. Try and be greedy when others are fearful, and fearful when others are greedy. I think it's a quote from Warren Buffett, but he might have it from somewhere else. But look up that and just try and reflect on that for a moment. So good luck. If you have any questions, let me know in the comments. Hit subscribe if you want more videos. I'll see you in my next one. Have a good one.